What is up, YouTube? Today I'm going to do something a little bit different. It is February 1st. We had a wonderful January with the Merc Trades group. It was just fantastic. Definitely a rocky start in the first couple weeks getting used to the new market conditions, but once I became accustomed to the meme market we live in, I started doing much better and trading much heavier, and we ended up with a wonderful January, to say the least. Anyways, if you followed the Twitter trades yesterday, we hit 4 for 4, all of them over 30%. A couple of them hit right around the 100% mark. For Friday's position, the swing we took ended up closing out at 600% gains, pretty good. And then for today, I want to do something a little bit different. I do want to talk about implied volatility a little bit and the put and the call skew. So what is implied volatility? Well, it is the likelihood of a stock to rise or fall, and it's basically the expected range that the market makers are placing onto a stock. And it's based on the historical performance of that ticker. So when you see SPY start doing insane moves, the volatility is going to start rising. And what does this mean for options? Well, as the volatility is rising, the price of premiums is going up to protect option sellers, right? Because it's more risky, historically speaking, for them to sell calls $20 out of the money than it was a month ago to sell calls $20 out of the money. So because the risk is up, the reward is going to be up. So option sellers are getting a little more bang for their buck, and premiums are a little bit higher across the entire board. Now that's kind of the very basics of how implied volatility works. So the next thing is the VIX. The VIX is similar. The higher the VIX is, the more expensive premiums are going to be. So both of these things are kind of making premiums very expensive right now, which means it's hard to get great swing entries, but it means that you can have some really good returns on investment. Because the market's making such big moves, it's just a little bit riskier because you're spending more on the premiums. So for the put and the call skew, what I wanted to touch on after briefly touching on the VIX and the implied volatility was the likelihood for a reversal based on the put and the call skew. I don't know the specifics of the probabilities, but one thing I like to conceptualize when I'm thinking of how the market moves, and one of the reasons we hit those trades so perfectly last week, was I was putting myself into the shoes of the biggest option sellers. So when the put skew's that loaded, they're the ones who sold the puts, meaning retail's making all of this money on the puts. They have millions and millions, billions of dollars in options and put premiums that expires, and it's not worthless, it's in the money. So if it does expire in the money, then they keep that money. But if it expires worthless, the market makers get to keep all that premium. So what ends up happening a lot of times is you'll see max pain is hit, and this is the market makers, Theta Gang, the institutional investors, the biggest investors are just taking money off the premium skew. So if the max pain is below the price of the stock, then they'll try to drive the stock price down to capture the call skew, because there's a lot more money in the call skew being left on the table. So pushing the stock price down means more of those end up out of the money, meaning they get to keep that premium. So when you see something like a 2-to-1 put skew and it's all retail buying puts that are 5 days from expiration, with this implied volatility being this high, like I mentioned, they're paying extra for this premium. They're out of the money within 5 days to expiration, and they're spending millions. This, to me, is not something an institutional investor would ever do. They'd go in the money a couple months out or at the money. Being that far out of the money is just too risky for a smarter investor. So it was retail buying a bunch of puts out of the money, and they drove the put skew to a 2-to-1 ratio, meaning while the implied volatility is high, while the VIX is high, they're paying twice as much as they should be for these puts, and the put skew just got so fat that it was almost a no-brainer for me to expect a reversal. And lo and behold, we did, and we caught a nice 600% trade if you held that to expiration. I obviously did not. I almost rarely ever do. I'm usually riding the wave, so I'll be on to the next trade by then, but some people did. I saw their gains, and that always makes me happy. So yeah, that's one way to kind of view the put to the call skew and to conceptualize how with this implied volatility high, it becomes a seller's market. And then when you're within this option seller's market, you have to look at the skews, because it's a seller's market, they're going to try to play from skew to skew. So what they do, right, is they'll drive the stock price down, put skew gets fat, and then they'll start driving it up. And as the stock price starts to rise up, you're inverting the put to call ratio. So now, rather than having a 2-to-1 put to call ratio, we have a 1-to-4 put to call ratio. So now we're starting to think, okay, well, this is too high too fast. So the call skew is actually starting to get a little bit frothy. So what does this mean? Well, this means that we're not going to start trading short because we don't want to fight the main trend. But unlike Monday or Friday and Monday, I'm not going to trade as heavily today long. Rather, I'm going to coast in positions, take smaller positions, and expect volatility to the downside for the reasoning that I just stated. The implied volatility is so high that the premiums are so lucrative, it's so expensive, that it makes a lot of sense for market makers to try to put some downside into the market. And I'm not saying this will cause a sell-off. No. Even if they keep it flat, they'll crush all that premium because the implied volatility is very high and we're trading on this trajectory, right? So this is what calls are being priced on. It's saying, oh, sure, we're going to be at 470 in a couple days, right? More than likely we won't. But that's what calls are being priced on when it's trading this trend. So anything that's expiring by Friday is pretty much traded way too expensive, and people are buying them. So that means that the call skew is getting very fat. And as today pans out, more than likely, I expect a flattening out as we start to hit these resistance ranges. So this basically becomes the end point of my pivot zone. So now I'm no longer trying to enter new trades. I'm more so just managing the trades I have, waiting for volatility and an IV crush. So if the stock starts to consolidate, then I don't have to worry about this so much anymore because we're no longer trading on this this trend. It'll start to trade on this trend, right? And then the premiums will go a lot cheaper. Excuse me. So for today, smaller positions for me, I'm waiting to see if we see any downside volatility. I know that the whole market's a little bit frothy right now. I also know that FOMO is very real. People like to buy when things are doing well, so they're going to want to put their money in. So I don't want to necessarily start shorting the day right away, but I do want to be cautious of a rug pull, keeping in mind that the put to call ratio is now very, very bullish. So bullish that it it makes more sense for the market makers and theta gang to drive the stock price down or flat for a couple days. So after the morning IV, I will post some Twitter trades. I'm going to do 20 this week. So we've done 4 so far. All 4 were over 30%. I'll post 4 more today. Let's see if we can get 8 for 8. And then make sure you check out the Discord. I opened up the chat to everyone because the beginner chat was just a little bit dead. So now everyone, even if you're not a premium member, can enjoy the premium chat, which is pretty fun. Definitely not PG rated. So before we end this video, let's go through just the last 2 things. I want to go over some fibs real quick for us. So because we're moving up, we want to see the fib from the low to the high. high to the low, I apologize. Because we're moving up, right? So when you're moving down, you'd want to go from the low to the high. So whatever, we'll explain it all later. So anyways, for today, the fib ratios that we're looking for is the big one, which is the 60 retrace. It's a huge selling point. So for today, anything above 450.26 I'm bullish. I do think that I would try to put some sell orders in for my runners around the 61.8 retrace mark, which is the 457.22 on SPY, just because this is going to be a natural sell or sell zone. So for today, just a basic trade plan. We'll just keep it real simple for now. I already kept this video over 10 minutes. I didn't want to do that. I was going to go through fibs real quick and just do how you would bounce between the two fibs, rather how you trade the two different trends. So for instance, if we're going to start going down, I do want to go from low to high, right? So if we're going to start retracing down, so I could take this drawing, fix it real quick. We could expect a push down, right, to one of these fib ratios, which would more than likely be where all the resistance lands, right at the 61.8 again. So that would be, if we see immediate downside and sharp, we could expect to move on these fibs. We would use the bearish set of Fibonacci's to see where we would gauge, and this would be a smaller move, right? Because macro wise, we're looking at the bigger fibs. We're expecting a move this way, and then micro wise, we want to see where on this move will come down, right? And then when you're playing the micros, you can start to find your entry zones. So obviously it's not going to be perfect like this, but that's kind of how you can conceptualize just trading the two different fibs. So you have your macro trend, which just shifted from bearish to bullish for the time being. Obviously, we have a long way to go to get back to a new high, but for the time being, we're bullish. So that's our macro trend. So we're going to be using the bullish fibs. And then we're looking for where our zone will probably end. So where does this wave most likely end? Well, this wave will most likely end somewhere in this zone here. And then from this zone here, we'll more than likely see downside. And that's kind of how you would gauge your moves. So we're so yeah, for today though, just playing a little bit cautious. I do expect some downside at some point. I don't know if it'll be today, but I am going to start taking smaller and smaller positions bullish, just because this wave is coming to an end. You know, surfing's fun. You can ride a wave, but it doesn't last forever. The wave will eventually crash, and you don't want to have all your eggs in the basket when the wave crashes. So I like to trade heavier at the start of pushes and then slowly scale out towards the end, and then be prepared to shift positions bearish once it becomes overbought. Anyways, that is my video for today. I apologize for going to 13 minutes. And I will go ahead and touch base on IV and put and call skews a little bit more later today. I am going to be working on that one. And then make sure to let me know in the comments below what you'd like to see. Let's have a better February than we did January, which is pretty awesome because we had a wonderful January, so we'll keep the year going off to a great start. And let me see if I can drink some more coffee to kind of wake up here, because I am stumbling on words. But anyways, to a beautiful day.